The tension on Wall Street is palpable as stock futures remain virtually unchanged, while investors eagerly await the Federal Reserve's highly anticipated announcement on interest rates and its economic outlook. But here's where it gets controversial. What the Fed reveals could reshape the market's trajectory in ways many don't fully grasp yet. Late Tuesday, futures tied to the S&P 500 edged up a mere 0.02%. Closely mirrored by Nasdaq 100 futures also gaining 0.02%. Meanwhile, Dow Jones Industrial Average futures nudged higher by about 13 points or 0.03%. These minimal moves reflect cautious sentiment as traders prepare for the Fed's policy decision scheduled for Wednesday. Market experts nearly unanimously predict the Federal Reserve will reduce interest rates this week, likely as a 25 basis point, 0.25% cut. This strategy aims to invigorate the U.S. economy, which is showing signs of a slowing job market, even though inflation remains stubbornly above the Fed's preferred 2% target. Along with the rate change, all eyes will be on the Fed's dot plot, a graphical summary of policymakers' projections for future interest rates over the next year or so. This forecast offers critical insight into the central bank's long-term game plan. Another key aspect traders will scrutinize is whether any Fed officials dissent from the majority's decision. Last July saw two notable disagreements, suggesting not everyone is aligned on the path forward. Current market pricing places a 96% probability on a quarter-point rate cut, with only a 4% chance the Fed might surprise by lowering rates by half a point on Wednesday. These probabilities are derived from trading activity in interest rate futures at the CME Group. Paul McCulley, former managing director at PIMCO, shared his take on CNBC's The Exchange program Tuesday, highlighting why a more cautious 25 basis point reduction is the most plausible outcome. Honestly, to justify a 50 basis point cut right now, you'd have to argue that the labor market is in severe distress, McCulley explained. That's not the message Chair Powell wants to send, not at this moment. This insight reveals just how carefully the Fed balances economic signals before making bold moves. When the dust settled on Tuesday's trading, major indices showed little change. The S&P 500 touched a new intraday record but ended the day slightly off its peak. The Dow Jones Industrial Average slipped 125.55 points, marking a 0.27% drop to close at 45,757.90. The tech-heavy Nasdaq Composite, which hit a record close just the day before, failed to push higher Tuesday. In corporate news, Cytokinetics saw its stock rise roughly 1% in after-hours trading following the announcement that the biopharmaceutical company plans to raise up to $550 million through an offering of convertible senior notes set to mature in 2031. This move signals strategic financial planning amid a dynamic market. But the debate heats up when considering the Fed's tone. Subadra Rajappa, head of U.S. rates at Societe Generale, warned on CNBC's Fast Money that stock markets could face a sell-off if the Federal Reserve adopts a less dovish stance than what the market currently expects. If the Fed signals it won't act as aggressively as the market is pricing in, we could see an unwind. She cautioned, highlighting how sensitive markets are to subtle shifts in policy language. As of the latest update, stock futures were holding steady, with little movement as investors braced themselves for the Fed's critical announcement. The previous day's trading session saw the SP reach an intraday high, but futures contracts associated with leading indices remained close to flat, showcasing a careful and uncertain mood among traders. And this is the part most people miss. The Federal Reserve's announcement is not just about the rate cut itself, but the narrative and guidance that accompany it. How will policymakers frame their outlook on inflation, employment, and growth? Will there be hints of disagreement pointing to deeper divisions within the Fed? These nuances often cause ripples far beyond the initial reaction. So here's a question worth pondering. Do you believe the Fed should act more aggressively to combat inflation, or is a cautious approach better to avoid disrupting a still fragile recovery? How might these decisions shape your own investments or economic outlook? Share your thoughts and let's dive into the debate. After all, the Fed's moves don't just influence markets. They affect the financial lives of millions.